makes it kind of, I'll put it on the ground if I. Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Had a couple weeks off, and we're coming back. We got this show and one more show next week for this year. So looking forward to finishing strong here. We do this show to help people with their retirement, the financial aspect of it, retirement planning, how to manage your money, how to reduce your taxes during retirement. We do this by answering questions. So you can send your questions in now if you want. There's two ways to do it. You can send them via the chat, or you can send them the email address right here, asktom@talkmoneywithtom.com. We'll try to answer those live. We get a lot of questions, sent in during the week. We have these strategy sessions with our clients, and sometimes we'll highlight some of their questions. So looking forward to that. We've created this channel, Talk Money with Tom, just as a resource for people to use to be able to, up their education in an area that's really difficult to find information, in my opinion. And so you can go to the channel, you can subscribe. You can hit the bell button to get notified when new stuff comes out. And I think we have over 2,000 videos on there now or something like that. So obviously you can start to look at those. And lastly, if you just like to ask questions on a personal basis and meet with us, you can do that. We have a book appointment button on our website. It looks just like that. It's up in the corner. A link for the website is here on this channel too. So set up a 30-minute time to meet with Ethan and I, and we can answer your questions directly that way also. So we're just looking to try to help broaden the education of this particular category and hope that you get something out of this that you can really use. So I like to start off each show with a summary of what I saw happening in the stock market this week. And so we'll start with the chart that we've been looking at for several years here. You can see what's been going on. Really strong stock market right now. We hit the 54, 55, 56 all-time high. I think all of those happened this week.
Yeah, Bitcoin finally broke that 6-digit barrier.
Yeah, Bitcoin's going crazy. The market is very strong and continues to be strong. And lots of momentum. The primary direction is certainly up. And there's a lot of reasons the market's up. And so we're going to talk about those. And it's been a long time, but I have used to do a thing called Positive Friday. And the object behind this entire channel and this whole show is really the genesis for why it started. If you look at that big drop during the pandemic, at the very bottom there is when the show started on the 23rd of March, 2000. And at that time, I was just trying to point out what was positive that was happening, because it was a pretty dark time with the pandemic. The market dropped 35%, fastest 35% drop in history. And my objective was to say, okay, look, we can all see the negative. It comes out, it's in the press, it's what sells, it's everywhere. But it's sometimes difficult to see the positive. And to be a good investor, you need to have both sets of information so that you can have a balanced approach. Sometimes the negative does outweigh the positive, and you should be nervous or out of the market or whatever it is that you want to do with that information. But a lot of times I think you can't be a really good investor unless you have that balance of information. So that's what we're trying to do in this show, is do this, kind of positive pieces. And so I'm going to switch back to just the two-person here so we can just talk about this. And Ethan and I can brainstorm kind of all the positive things that we see out there. Now, you have to keep in mind that some of these things that are positive for the stock market may not be positive overall. Okay, so for example, reducing regulations. Okay, that's good for the stock market. I mean, it reduces the costs, right? I just read an article saying that $90,000 is the average cost of regulations for a home. So if you got rid of that, homes would be cheaper. Construction companies might do better, right? But is this better for the environment? Is it better for the workers that are working in these? Or
the actual consumer too.
Or even the actual consumer, exactly right. Probably not. But this is one of the platform pieces that they're talking about. And so again, looking at it from the stock market standpoint, which is what I'm trying to do here, I'm trying to point out, where these things can be positive. 'Cause people keep asking me, with all these negative things that are happening, or all these negative things that are being brought up as possible platform issues for next year with the new administration, why is the stock market hitting all-time highs over and over again? And here's why. Okay, we're going to go through this list. Okay, so first of all, the one thing that's happening right now is the stock market's broadening out, and this happens before the election started. We had this Magnificent Seven kind of narrow run, and you will see that Magnificent Seven do well when things are a little bit murky, because their cash flow and their cash positions, their name recognition is unparalleled. That's why they're so big. We're seeing a little bit of run in them right now. Again, kind of went away for the summer, but again, I think that's partly because there's some, worrying about what might happen next year. But if you look past that, we're seeing small caps do well.
Yeah, it's been a while.
Yeah.
Over the summer, we had a small cap run, and then it kind of fell back down.
Yeah, and they're running again, right? I mean, not a bad year. I think small caps are up 20%. They're not up as much as the S&P 500, but that could change next year. We're seeing mid caps do well. We're seeing the equal weight S&P 500 outperform the capital weight. So basically means that the small and mid cap companies in the S&P 500 have an equal say in the price movement. And so that just means that we're seeing some broadening. It's one thing we watch for all the time. The primary direction's up, right? I mean, we've just looked at that chart. There's no doubt whatsoever primary direction is up, and that hasn't changed for 2 years, okay? And so what's important about that is that the average primary direction up, otherwise known as a bull market run, is 5 years, okay? So 5 years long. We're 2 years into the 5 years.
So a little less than halfway.
Yeah, so on average, we have more room to run, okay? If we look at the returns in that 2 years, roughly 70% so far since the bottom in October 13th, 2022. And the average return on a bull market is 180%. So again, on an average basis, we have some room to run. The economy's strong. Yeah, I mean, gross domestic product keeps coming out in that kind of 3% annualized range. It's doing quite well. It even got revised up this year for one of the quarters, which is kind of nice. Consumer spending continues to do well. I think there's a lot of pieces there. Kind of have that pent-up demand, and people want to get out and do things. It's still going, right? People are still traveling. There's lots of travel plans. And wages, today's jobs report showed that wages grew 0.4% for the month and 4% higher than last year.
Yeah, and that's outpacing inflation.
Yeah.
And so over time, people are getting more money.
Yeah. And you combine that with a healthy job market, because the job number came out today at 227,000 jobs created.
I think they had 56,000 to the previous 2 months.
Yeah,
too.
so it's kind of nice to have an upward revision, because they had a downward revision for the first half of the year. but yeah, so we up revised the last 2 months by 56,000 jobs. Plus we had 227 today. The expectation was 220, so it met the expectation, which is good, because we've had a couple of that fell below. And so that's a healthy consumer, right? They have jobs. Unemployment did tick up one tick, right?
It's up to 4.2 versus
4.2. So as a whole, the job market is, I wouldn't say it's spectacular, but it's good, right? It's especially for what it needs to be for the stock market, as far as that goes. Of course, we have robust earnings growth. I mean, quarter after quarter after quarter, 75+% of the companies beat their expectations for reporting on earnings. So the analysts expect this, companies do something better, right? And I think that's happened 10, 11 quarters in a row now, where there's been at least 75% or higher. That's not normal. That's a really good run, actually. And so if you have 2 years in the S&P 500 where you have 20% or more in those 2 years in a row, which we've just done. Well, we're not done yet, but looks like we should get there. Then you end up with a scenario where the third year on average is positive, okay? And so again, that's not an expectation that a lot of people have right now when they're worrying about the market, but on average, the third year after these 2 big years is positive. Now, that could be 1% or something along those lines, but still it's better than negative. The valuation of the market right now is high, but it's nowhere near the peaks that we've seen before things really started
Yeah,
to
like
turn
the
down.
'01 or the .com
The
peak.
.com peak is a 45 PE. We're nowhere close to that as far as that goes. I think the other part of that is looking at the the breakdown of how a bull market plays out, right? So you kind of have this solid start, which is definitely what we've had: real companies, real earnings, the
Yep.
Nvidias of the world making money, and then we'll start to IPO things. I think that starts next year. Gets a little hotter, and gets exciting, and money starts coming in. The problem with IPOs is that they actually start flooding the market with more shares, right?
Hmm.
And right now, the dynamic that's really happening is no IPOs, and companies are buying back their shares. Okay, so that's still probably going to continue to be the dominant story for at least the first half of next year. But IPOs will start. IPOs, when they first get going, to bring enough excitement to get everything to rise.
Yeah, and usually the IPOs at the beginning are very solid companies
Yes,
that have
that's
been
right.
waiting for the right
Yeah.
time.
And that's the next step of that kind of culmination of a bull market, is when those IPOs get to be really ridiculous. Bingo.com is my favorite story about the .com bubble as far as that goes, and the SPACs that happened at the end of the 21 time frame. So we'll be watching for those. We'll be talking about that. Wow, that doesn't make sense. There's always something that doesn't make sense, but it becomes much bigger. It
Hmm.
becomes actually the story as far as that goes. So we're pretty far back in that lineage of how a bull market works, right? We don't have a lot of those other things in place that would say, hey, this is really out there. We need to really be careful. We're still in the middle innings of what would be a bull market as far as that goes. So lower corporate taxes. So the talk on the campaign trail was to bring corporate taxes down to 15%.
Yeah, for U.S. companies.
For U.S. companies. That's a huge deal. I didn't hear any talk about bringing. Janet Yellen has been working on a 15% tax rate worldwide,
Yeah.
and that, for some reason, that stopped. There was a lot of traction on that. The advantage to the U.S. there is unbelievable, because you got big U.S. companies running money through Ireland because they have a 6% rate, who might now run their money through the U.S. because the rate's still the same everywhere.
Yeah.
That needs all of the major countries that you would run money through are at 15%. So that might fit in. We'll see what happens there. I find that quite exciting as a whole. It could be a really big deal. We talked about lower regulations. That stimulates the economy, it stimulates the stock market, it makes earnings better. Reducing the cost to run government is part of the platform, right? Any of these can be taken too far.
Yeah.
You reduce it enough, you actually take away money that is going into the economy. But there's always, every company and certainly every government agency has some, inefficiencies.
Yeah, and you usually see in downturns where those inefficiencies, like
Yeah.
companies always have layoffs, and
Yeah.
usually it's the most inefficient employees that are laid off.
Yeah, exactly. So we'll see how that plays out. But at the moment, that could be a positive also. Uh, uh, for Trump himself, he uses the stock market as a scorecard. I think that's important as an investor in the stock market, that he really looks at that. He pays attention to that. I felt like in 2018, when he was doing the tariffs, stock market was dropping. He backed off on the tariffs, and the market finally came back. They're still out there. It's not that they took them away, but he stopped doing additional tariffs at that time. So, he had a 67% rate of return on the S&P 500 during his first term, even with all the chaos that happened from the pandemic, the January 6th, riot at the Capitol. Stock market did pretty well under his term, at least partly because they lowered the capital gains. Lowered the corporate tax rate.
Yeah, and they also lowered just the tax brackets too.
Yeah. Okay. So again, good and bad, right? You lower tax brackets, you increase the deficit, but until the country goes broke, that's stimulative to the stock market. That's just the way it is. So if you're looking at the next 2 to 3 or 4 or 5 years, and tax cuts would be incredibly important, both on the personal side. So, I mean, they're talking about some really big deals. Number one is keeping the 2017 tax, cut
Brackets, yeah.
in place, maybe permanently. I did read an article today saying that if it would have gone back and sunset back to where they were, that would have been the largest tax increase in history. So possible, keep it, right? All these are possibilities, by the way. The Social Security tax, taking that away, taxes on tips, taking that away. Repealing the SALT, where you have a $10,000 cap, right? Yeah. So if you get to write off your full property tax plus all of your state tax, I have more money to spend, to invest, to stimulate the economy. correct? So if I don't have to pay taxes on Social Security, right, that's money that's going to come back into the economy. That's all stimulative. The stock market, this is why we're hitting all-time highs. I'm telling you, this list is why we're hitting all-time highs. The Treasury Secretary that was announced is Scott Bessent, and he was very well received, actually. He's considered at least the adult in the room.
Mm-hmm.
I find it kind of interesting. If you look at a lot of the cabinet picks, seems to want to really mess with the FBI, the CIA, the health department, the education department, all of
they're pretty radically different philosophies.
People that don't even like these organizations are going to be running them. But all of a sudden, when you got to the financial thing, boom, we bring in an established Wall Street likes this guy. So again, I think this administration does, at least in this case, look at those kind of economic positions and the economy as a whole and the stock market as a whole as a scorecard. So I think that, again, I think that's a positive. The market went up when they announced him as the thing. Capital spending is up. So companies are spending on, different devices and what have you. Artificial intelligence is here. Trump has talked about it, seems to be favorable to it. That's good for utility companies because these artificial intelligence centers take massive energy, right?
Yeah, I was hearing something about Meta wanting 1 to 4 gigawatts of more power for their data centers.
Wow. So we're seeing utilities run. This is good for financial firms because financial firms are very heavily regulated, right? So there's some pockets that we're seeing running as far as that goes, right? Estate taxes, if they continue the current tax brackets and all that, they would likely also continue the current estate tax benefit. So, it's going to be, I think, about $14 million per person if you have a trust, and you can kind of do it too. That could go through without taxes versus going back down to maybe 7 or 6 million, depending on how they ended up doing that. If they let that sunset, as far as that goes. So again, I think could be stimulative. Taxes coming out of the economy are not good for the stock market in the end. Sometimes it comes back in as government spending, right? But it doesn't all make it back in. The step up in cost basis is likely to stay in place. Okay, so. I don't know, this is maybe not directly related to the stock market growth, but when the Democrats had, and I'm not trying to be political here, but this did come up. There was conversations when the Democrats had the House, Senate, and the White House about the possibility of getting rid of the step up in cost basis. So what happens is you buy a stock and you hold on to it for your whole life and it's grown dramatically and you got this huge gain. And you pass away, your heirs can sell it now with the step up basis to current value, and that wipes out that whole taxable gain. I think that's probably the biggest tax benefit in the investing world that I can think of. It got dropped. It didn't happen. It wasn't real serious, but it's not something you're going to see out of this administration. So I think that's, again, could be a positive. The last 9 times that we had a positive day, the day after an election, the market was up every time. At 12 months later, an average of 9.5%. So we had a 2.5% jump the day after the election this time. So again, looking at averages, not bad. And here's maybe the most obvious one: the Fed is lowering rates. We're not raising rates. Who knows what will happen next year? But there's still, I think it's at about a 75% chance, at least as far as the market's concerned, that they would lower rates next meeting, which is the 18th of December.
A couple weeks.
Yep. And so the stock market loves lowering rate environment. We talked about all those stats in the past and such too. So anything else you can think of?
No, it's a long list of actual net positive.
It is, and so that's what I mean. I bet you the average investor would have a harder time finding all the positives than the negatives. That's why we're here. We're going to try to keep doing this and keep pushing this out here, just to give people a balanced approach. Now, do we think the market's going to skyrocket? I think this is going to be the most unpredictable year, 2025, just because of what was said on the campaign trail. And what might actually happen. It's just, deporting all of the immigrants in the country that are here illegally, would be devastating, in my opinion, to the agriculture and construction industries. And, so I'd be surprised if some of these things really happen, but you got to take it into account that it's possible. So, yeah. However, if I'm only focused on that, I'm only focused on tariffs and what they're going to do to prices and those types of things, I might be making the wrong decisions on my investments, right? If I understand all of those negatives, which are thrown at me every day, easy to do. We could sit here and brainstorm negatives like nothing, and it wouldn't even be new news to anybody. Versus, hey, here's the list of positives that's happening right now. It's pretty strong. It really is. I mean, this is a pretty strong market. And that's one of the things that all of those negatives are going to have less impact, because the market's not in a position of weakness, it's in a position of strength. And so it could still have an impact, but it would be less. If we were teetering on the edge of 2022 when everything was kind of falling apart, or 2008, and we were talking about doing all these things into the teeth of it, Lehman Brothers going out of business, yeah, it wouldn't take a lot of negative to kick that even farther down. And so anyway, that's the summary for the week. Positive Friday seems like a good time to do it. We only have one more show this year, getting ready for next year. And there's been a lot of concerns about what, and a lot of questions about what might happen with the new administration and how that might impact my account. Honestly, we don't know, but here's the list of positives for you to look at and think about too, as far as that goes. So thank you for joining us. Again, we'll be here again next week. We'll do another summary. All right, what's our first question?
So how do you deal with anxiety with market uncertainty? A lot of people feel like right now we're in kind of a bubble, they could say, where we've gone so well for so long that something's bound to happen.
Yeah. I mean, let's look at it just from a pure biological standpoint, as humans, and the humans that paid attention to risk when the risk was life-threatening.
Yeah, the tiger in the jungle.
Tiger in the jungle. They're the ones that survived. So here we are. We're the manifestation of this group that survived looking at risk and focusing on risks. And so it's a human thing. And so even when things are going good, and everything's set up just right, we're still focusing on this risk, and that's what brings this anxiety. And so you kind of have to fight that. It's just part of our, brain work. It's how things happen. Some people are better at it than others. I think some of the things that helped me a lot is like what we just did. We did Positive Friday.
Yeah. And you can also look at just past events.
Yeah.
You survived a global pandemic.
Yeah.
You survived the '08 crisis. You survived the .com bust. You've been through ups and downs, but you've always come out at the other end.
Yeah, those are all really tough, right? But we look back at them now like, oh, okay, But when we look forward, we don't think the same way.
Yeah.
We think it's going to be even worse or something along those lines. Yeah.
And most people say don't bet on disasters.
Yeah.
Humans, we've always found a way to make something work.
Yep. Yeah, exactly right. I mean, whether it's personal and you'd have to deal with it, or if it's the world, in either case, we're actually pretty good at kind of figuring things out, in my opinion. So that's so have a positive list that you can at least refer to offset some of the negatives that are hitting you. Understand that these things are temporary.
Mm-hmm.
They can be, 5 years or whatever, or maybe even longer, but they're definitely temporary. We can usually overcome them. And I think, and then understand some of the basics too, because if you have more knowledge, and that's what this show is about, is trying to increase knowledge, you'll understand that we're not at a peak level like we were back in 2000, like we were in 2008. It's high, it was all-time high, but earnings growth has been really robust.
Mm-hmm.
And companies have been able to, help their price-earnings ratios by bringing up that earnings side. And so we're not there. And again, things could turn around tomorrow and fall and, what have you. There's always that outside influence thing that can come in. But
yeah, and there's other questions you can have is like, this is a good time to say, is my emergency fund enough?
Yeah.
Because if you have enough of it in your emergency fund, that's kind of the way,
Yep.
weather the storm.
Yep. I highly encourage people to really identify the amount of money that they need to have in the bank. So just imagining, or something like that, some safe investments, T-bills, whatever it is. Imagine going to bed when the market's continuing to fall and do really terrible, like say 2008, dropped 57%. It just kept going too.
Yeah.
It seemed like it was okay, then it wasn't. What number do you have to have in your bank so when you go to bed you think, okay, that's horrible, but I have this in the bank?
Yeah,
and that's different for everybody.
And the thing is, the market's always come back.
Yeah, it has. And so have some cash to be able to live off of instead of withdrawing from your accounts if you happen to be. That's another thing too. Really identify like when you're going to need this money, because a lot of times I see people with high anxiety. They don't need the money for like decades. They're worried about losing money right now. The market has shown a pretty good resiliency to come back. You got to kind of have some belief in that. If you're living off of it now, that's different, right? Okay, that's a whole different scenario. You really want to make sure you have your cash. Maybe you can live off that cash for that period of time, let the market come back. But I have a lot of clients that still have some anxiety, even though they're not needing the money. So,
Yeah, it's most likely why they have the money is that
yes,
anxiety. But
that's right.
it's so it's hard to turn off that anxiety.
It is. And so basically what you want to do is complement it with kind of the positive side of the picture. Oh, I have this cash. These are the good things that are happening in the stock market and the economy, that kind of thing. And so, yeah, I don't think anybody, you're exactly right. The number one reason that our clients are clients and have the net worth that they have is because they worry about money.
Yeah, and it's a totally natural feeling to have this fear. It's nothing abnormal, but it's when it starts to affect your daily life, that's when it becomes a problem.
Yeah, exactly. And you got to set, if you're anxious right now, right, market's hitting all-time highs, then it's good to start working on that anxiety now, because when the next downturn, which is inevitable, happens, you'll be in maybe a better place.
Mm-hmm.
Yeah, that's good question.
So what's the difference between a traditional IRA and a traditional 401k? The accounts are pretty similar, but what's the major differences?
Let me get my visual up here. I touched my screen by accident. So an IRA is through a broker dealer. You can get them at the bank.
Anyone can basically, if you have any earned income anywhere, you can get an IRA.
Yeah, exactly. And so when you're looking at a 401k, you're going through a company to set that up. Mm-hmm. And so that's a difference. I mean, you have to have a job. You have to have a company that has a 401k or some type of retirement plan. You need to have big advantage. You might get a match, mm-hmm. right? So that's a huge advantage of 401k. But just in terms of structurally, what you're going to have as far as different goes, just has to do with kind of the way that they're built. So 401k is coming out of your paycheck, right? Sometimes that's easier. Maybe there's a match. With IRA, you're generally writing out a check or doing some kind of
sort of transfer from some other account,
contribution or something. The limits for putting money into a 401k are much, much higher than the limits putting money into an IRA, right? You have some income limits to what you can put into an IRA if you have a 401k, if you have access to a 401k.
And you want to get a taxable deduction. So the nice thing about 401k, you can have unlimited income and get a tax deferment on that.
Yeah, exactly. So that I think is interesting. There's some different provisions for withdrawal that are different between the two. The IRA has the...
So like the IRA, there's some like special withdrawal things, like for your first time, if you're a qualified first time house purchase, you can take $10,000 out of your IRA. If you have qualified higher education costs, you can take it out of your IRA. But a lot of the same hardship applies for the IRA and the 401k. So essentially, you have kind of both options. So it's nice in a sense that they're both kind of the same beast, just in a little bit of different capacity. And really, the investment options is kind of 401k is limited to what the company decides is your available, or the kind of custodian. While with an IRA, whatever, you have a much bigger, decision pool.
Yeah, that's always been the biggest deal to me, is the ability to choose more options for investing. If you can make 1 or 2% a year more in anything, if you look at how that works across a financial plan across your life, it's an amazing differential. Amazing. So if your 401k and the limits on what you can invest in is holding back you from getting that extra 1 to 2%, that's a big deal. Now, unfortunately, more choice for some people actually means less money.
Yeah, you
So
get analysis paralysis.
Yeah, well, you just get out into things that you shouldn't be out into. But For example, for us, we run this 181, ETF list, and we're using this momentum and these little, pieces to figure out what we want to be in, and we're looking for things, the waves that are moving up. You can't do that with a 401k. There's usually, you'd have a hard time actually creating an entire portfolio in some of these, to cover everything. So most people just do these target date things. Target date has, I don't know, a lot of them have 20+% in international, which is great when international is running, but it hasn't run for so long. It's ridiculous. So you're actually making less with those target dates than you can if you constructed your own portfolio. So they do have some 401k options at some companies where they allow you to basically go out and open up a brokerage account, and then you can use that like an IRA and kind of buy and sell what you want.
I think the companies noticed a need, a desire, or just a people that didn't. Basically, they were having issues where people didn't like the investment options, and so this was another way for custodians to kind of help out in a sense.
Yeah, I mean, they're not real different. I mean, if you look down the middle, retirement accounts, you can add money in gross tax deferred, and there's limits, right? Different limits, but they're, kind of similar. Anybody can start an IRA, it has deduction income limits like we talked about, but there's a variety of investment types, so that's big. And so they're both good. There's nothing really wrong with them. If I'm out working at a company, I'm open up a 401k. I'm going to put in enough to get the match at a minimum.
Yeah, because
no matter what.
Yeah, if it's like if it's like they match like 1% for every 2% you put in, that's a 50% guaranteed return.
Yeah.
Or if they match 1%, or if they match up to 3% of your salary that you put in for 3%, that's 100% return on that 3%.
Yep, and that's one of the most powerful things in finance is the match portion of it. I think the differential really runs around, once you hit retirement or once you leave that job. Do you leave the 401k there? Do you roll it into the 401k of your new place? Or do you, take it and roll it out into an IRA, right? So that's when you want to really consider the pros and cons as far as that goes.
There's also like one really kind of niche topic with a 401k. So let's say you're 55, you're at a company with a 401k and you leave that job. You can start to withdraw from that 401k, only that 401k, without any kind of 10% penalty for early withdrawal. And then you can do that until 59 and a half. So you have 4.5 more years that you could withdraw penalty free if you're taking money out.
So under that strategy, every company you work at, you'd open up a 401k, and as you go to the next company, you'd keep rolling it into that next company. So that by the time you got to, let's say I'm planning on retiring at 55. And so now I'm rolling it in. I got this giant 401k, and it's my last 401k. I retire. I now can take money out of that without penalty up, because normally I would have had to wait till 59 and a half, and I could start at 55. I'd say a better strategy, though, if I was going to retire at 55, would be to build up assets outside of retirement plans because the taxes are better. So cash assets, stock and bonds that are in regular brokerage accounts that are just in your name or in the name of the trust, usually is what we want to start off a retirement on, because either you've already paid taxes on some of it, so you can take that for free, or you have a capital gains rate, hopefully long-term capital gains rate, which is lower than ordinary income. Because if I retire at 55 and start withdrawing from my 401k to live off of, all of that money's taxable. If I have a taxable account set up, outside, I can really lower my tax rates during that period of time. And then I can take a look at Roth conversions in that window instead of having a higher income that I'd have to do with the 401k. So I think there's a better strategy in that. But it is interesting. It is one of the pieces.
Yeah, and you can get around that with the IRA with the kind of the equal distribution, the 72T. So there's a ways that you can get around it. So it's like a very niche kind of like.
Yeah, the 72T is more restrictive than what they're talking about for the withdrawal from the 401k, but it's still possible.
Yeah.
So you can set up a distribution without penalty. We won't get into 72T in depth because it's really complicated, but there is a way to withdraw prior to 59 and a half from your IRA. It just has more, strings attached to it, so to speak. Yeah, it's a good question. I think that it's kind of interesting to see what, has been going on as far as that goes between those two. It's people confuse them a lot within our practice. I know that for sure.
Yeah, it's a very similar account structure. You take your RMDs at 73.
Yep.
It's very similar.
Yep. I think on a 401k though, they changed that rule where if you happen to be still working past
Yes.
73,
Yeah.
then you don't have to do your RMD.
From your
But
from
that wasn't true that long ago. I remember clients that were working, because it used to be 70 and a half. They were working past 70 and a half, and they were having to take money out, and they were putting money in at the same time. So that's why it got to be kind of stupid, and they changed that. But we don't have too many clients now that they've moved it back to 73 that are still working at
yeah.
that age.
So does the size of your emergency fund change with retirement? A lot of times when we're working, the general rule is 6 months. 3 to 6 months of just expenses in the bank.
Yeah, it's a complex question because the answer should be probably yes. Hey, all of a sudden I'm going to get to a point in my life. Maybe when I first retire, I could go back to work for a while. If I had to. But at some point, you might get to a point where you can't, health-wise, or when you're 85 or whatever it is. And so, in that environment of uncertainty, having more cash helps in the sense of, if the stock and bond market is falling apart, I've got this cash to live off of. And so it enhances, your, level of, safety within that retirement. However, there's a whole bunch of caveats to it. I mean, depends on what you have. Okay, so sometimes they say, hey, have 12 months worth of money on hand. Okay, great. But what if that's everything I have? Because I don't have a real flush retirement. I can't put 12 months of money in the bank and expect to live into my 80s off of that, because I'm not going to get the rate of return. So I'd say all of the rule of thumbs in the cash category haven't worked out in my experience working with people. But what does work out is like, what is it that you need?
Mm-hmm.
What do you need? And how does the plan like that? So, I need $100,000 in cash, and that's what makes me feel comfortable. And I have $1 million in total. Hey, let's put it in the plan, see what happens. So, what happens with the other 900,000 that's invested in whatever mixture of stocks and bonds? And does that work or not work? Can you do more cash? Because we can model, anything.
Mm-hmm.
We can put it down to 50 and see what happens. Put it up to 150. And so I think, that's where it starts. It starts with, what do you need, so that when you go to bed at night during a very bad stock market time frame, you still feel okay, because you can think about what you have in the bank, right? Mm-hmm. What is that number? And again, if you only have 100,000 and you need 100,000 in the bank, the plan's not going to probably work, in that regards. And so there's a different anxiety. So now you're having to balance anxieties. Okay, I'm going to run out of money at some point in my life because I don't have it enough to put it all in cash. Those kind of things. So that's I think it's a really good question. It's interesting to see. We get asked a lot about emergency funds. Matter of fact, it comes up almost weekly within the client meetings and such, as to what to have, what's the rule of thumb, do I have too much, do I have not enough, those kind of things.
And it evolves. So,
it does.
Different phases of your life, you have different higher emergency funds and like lower emergency funds.
Yeah, exactly. I'd say you should have as much cash as you need, as long as it works, and that is a perfect scenario. And so if you don't have as much cash as you need because it's not working, then work towards it. In other words, okay, I've got $1 million. I want to put 100, and let's say the plan doesn't work. I can only do 50. Well, work towards the other 50. Right? Start with what you can do. Make sure that your long-term plan is there, because that is the biggest risk in retirement, is living a long time.
Mm-hmm. Yeah.
And so, make sure that is taken care of, because you don't want your 90s to be miserable. It's already hard enough being older, versus where they could be financially. Making sure that works. And then, make a plan to get to that $100,000 of savings that you really want over time. Hopefully your investments work out well and you can do that. So it's definitely, there's some numbers and math you can do behind the scenes to figure out what you can do, but it's a good question.
So,
all right.
What is an expense ratio? I see them always associated with mutual funds and ETFs. And how are they charged? Who pays them, or how are they paid?
Yeah, so the Vanguards, the State Streets, the BlackRocks, who does the iShares, all of these big firms, Fidelity, right? Mm-hmm. They're big firms with lots of people working there, and so they make their money by taking a little bit of money out of each one of these portfolios, and that's what's called the expense ratio. So uh, they used to be quite high. When I first started this business in 1987, the expense ratios were probably, they must have been averaging about 1.25%.
Hmm.
They didn't have ETFs. They only had mutual funds, which had higher expenses, mainly because of the manager that was there, that kind of things. And so now I don't know what the average is, but I know in the ETF world that we work with, what's our average on our portfolio? Give or it's less than 0.25%.
It's usually somewhere point 0.1 to 0.1.5.
Yeah. Okay. So
So
that money is coming from you as the investor. Uh, Now we have a fee that's on top of that. So let's say we're charging a certain amount, and then you take out that zero point 0.1, 0.15. It basically just comes right off the rate of return. So in other words, if the investment made 10.15%, they take the 0.15%, you get the 10%.
yeah, and usually you don't see this as an actual
No.
transaction. They just take it. So they just take it from the cash reserves that they have, and they just lower the net asset value by
Yep.
that their fee.
Yep.
And so they take that fee. Usually, I think it's every market. You can look into the actual details, but I believe they try and take it a little bit every day,
Every day. Yeah.
so you don't actually notice it in the major returns. And so that's why you see like ETFs. Like you can look at Vanguard's VOO example. It's supposed to be basically all just the S&P 500, but there's a little piece that's just cash that they use to kind of take their fees from.
Yeah. Yeah. Yeah, it's a good question. It's something that a lot of people don't know. It's buried in some prospectus someplace. We can look it up and what have you. It used to be a big deal. A big portion of my career at the beginning was finding things with lower fees because if you're paying 1.25, you're losing a lot of money up front.
Yeah, that ETF or mutual fund has to do that much better
Yeah.
to outperform.
Which is why we were such big proponents of Vanguard at the beginning, because Vanguard is a nonprofit, and they basically return the money that they make back to the holders of their shares by lowering their share price, lowering their expense ratios, and they've got the lowest. Now, having said that, a lot of companies have gotten really close.
Yeah, I think Fidelity has some
Yeah,
of their like
they
they have
got
some
some
no
zero
fee.
ones.
They have
Yeah,
like some no fee ones,
yeah.
but I think they have some limitations there.
Yeah, but it's close enough now that it's kind of noise. You don't have to worry as much. Again, we used to really design things around expense ratios for a long time, and everybody like me that was doing that caused the whole thing to topple over, and those high expense fees are pretty much gone. They're still out there in some
Yeah,
crazy areas,
I think
unfortunately,
for
but
more niche
right.
fields, like if you're saying, "Hey, I am going to pick a certain country, a small country, and I just want a specific ETF,"
Yeah.
it's likely going to have a higher expense ratio just because the management's harder.
I wonder what the expense. I don't look at the Bitcoin ETFs. I wouldn't be surprised to see if their expense ratios were higher than average. It's a different market. It's probably harder to operate in
Yeah.
as far as that goes. But good. Okay. Well, one more question. Do we have a short one?
Yeah.
A couple minutes.
Should I ever co-sign to help out my child?
You're taking a risk of that loan defaulting or falling into your lap if you don't
Yeah.
default, or you're ending up paying it. Uh, Generally speaking, it should be on a. Are you talking co-signing for what? A car or a house, or
I,
just for anything?
so like the most common one I would think of when you co-sign for a kid is maybe a student loan is very common.
Student loan.
Cars are another one.
Yeah.
House. I
You don't
think
see the house as much.
I
It's
don't.
interesting.
I think for houses, a lot of times it's now a down. You give a gift of a down
Right.
payment or
Yeah.
something like that. It's
Right.
less that you join on that loan.
I've seen more like co-signing on auto loans over the course of my career than I have co-signing on a house. Yeah, you just have to be in the financial position to assume that you might be paying this,
Hmm.
because things happen. You can really trust your children, but something could happen to them.
Yeah.
Physically, they can get an accident or something, can't work anymore, and all of a sudden that loan is your loan. So make sure it's something you can pay. I think there's a certain aspect of, you got to find the balance between helping your kids and not helping your kids by
Yeah,
helping
letting
them
them
too
be
much.
independent.
Yeah, I mean, nobody co-signed for any of my stuff. I've worked my way up, and I'm proud of that. But sometimes if you get the right situation, you can push somebody forward, and they can go even higher than they might have with that help.
Yeah,
But
and you
yeah,
can see that with colleges.
yeah,
Sometimes stepping up and helping someone out for college, with the
yeah.
co-signing of their college loans.
Yeah, exactly. Yeah, college is interesting, because strategically, let's say even if you could afford college for your children, maybe you have them. You were telling me for you, your parents wanted you to pay for one of the years, right? Which I
Yeah,
think
yeah.
is a pretty cool idea.
So like I pay they wanted me to take out a portion and pay some loans, so I had
Right.
skin in the game in a sense. And so
Yeah.
they covered majority of the fees, which I'm very thankful for that. But like I had to pay some of them.
And that would be an ideal situation to co-sign on because you were going to pay it anyway. You're just trying to get your kid to understand, the value of the education and have to pay for some of it. And if they default, then you were going to pay it anyway, and as long as you had the money to do so. Assuming you needed to co-sign to actually get it,
Yeah.
sometimes you don't. But anyway, that's a good question. It's an interesting area. You get into this whole parent-child thing. It's kind of a fascinating thing that we deal with on a pretty regular basis as to what to do, and so be careful, but just plot it out the right way. Okay, that's the end of our show. Thank you for coming today. Really enjoyed this. Again, we will have another show, the last show of this year, next Friday. Really looking forward to that. So send in your questions now so we can start to do a little research on them and maybe come up with some visuals and such to do a better job of answering. Ask Tom at talkmoneywithtom.com is a place to send that. Secondly, of course, you can go see our channel, subscribe to the channel, hit the bell to get notified when we put new content. And up your education in this area. You can tell by just watching the show, there's a lot to learn. There's a lot of questions. There's a lot of areas to become proficient at in the area of finance, especially revolving around retirement. And of course, if you just want to meet with us and ask your questions directly, you can do that also. The book appointment button's up on the corner of our page, our homepage, and you can get to that through the link here on this site and set up a 30-minute time to meet with Ethan and I. So I want to thank everybody so much for coming. Look forward to seeing you again next week. Thank you.